For more on the market, let's bring in Scott Chronert this morning, U.S. equity strategist at Citi, who joins us here at Post 9. Good to see you, Scott. Welcome. What is your year-end target, and do you feel pressure to lift it at this point?
Well, we're at 6,600. We put it on early August. At that time, we were ahead of sell-side consensus, and we felt we had a good 5% upside run into the end of the year. We're surpassed that now. We're at 6,700 plus. And I don't feel any real urgency to change that. I think the way we're thinking about the fourth quarter setup is that heading into the Q3 reporting period, we're expecting very solid results, but unclear whether we're going to get sufficient upside surprise and estimate increases to support the action short term. So the way we're playing the fourth quarter is look for some volatility into the Q3 reporting period, but then be prepared to come in and trade that typical year-end rally as we get further down the Fed rate cut path.
You think EPS growth for the quarter can match what we got in Q2?
Well, it's going to be tough, right? So right now, expectations for the index are about plus 8%. I don't have any issue with getting to that number, probably a little bit above. But what you got with Q2 results was that beat, but also a raise going forward, which I think is really what supported a lot of the equity market since then. And where we're getting at there, when you look at what's implied in terms of the price action for this persistency of a beat and raise narrative, it's pretty aggressive. We've reflected that in some of our sector calls going into Q4. We recently lowered communication services to a market weight. It had been a 2.5-year overweight for me. So we're starting to allow for there's some element here where on a shorter term tactical perspective, so much is being priced in, it's going to be hard to give you enough incremental positives to support the price action short term.
In that sector. But what about in some of the other sectors? Do they look better set up?
Well, surprisingly, we're still overweight tech, and semis still look pretty good to us in this regard. Look at the financials. The banks are still in very good shape. So I think with the banks, we don't need a beat and raise as much as we need a persistence of just making or potentially beating the numbers. So I think, broadly speaking, across the market, there are areas where we think we're still in pretty good shape. But then there are those areas where I think you're paying a lot more for future growth expectations.
What do you see as the biggest risk for the bullish call?
So when we look at the S&P 500, the way we think about it and the way we're analyzing it is that roughly half of the market cap is AI affected, and then you have the other half. So I have to make two market calls here. The AI affected portion and everything else. I'm probably a bit more concerned about the AI affected part just because of the heightened expectations. Again, I don't question the persistence of earnings growth over the next several years. It's just a question of the magnitude on a shorter term basis. Can you continue to feed the momentum that's been so important to this part of the tape? We think longer term fundamentals are in very good shape. We're just trying to be a little bit more sensitive to some of the shorter-term volatility risk that we see coming up in the quarterly reporting period.
We did mention earlier this sort of mild rollover in the XRT and some consumer discretionary. You think it's related to, I don't know, year-end uncertainty regarding the shutdown or worries about employment, something else?
Yeah, well, I think the labor condition comes up in like every client discussion. It continues to be an issue alongside valuation. Those are probably the two that we're discussing most. And we've gone into Q4 leaning more into, let's call it the cyclical part of the market. That's going to be banks. It's going to be to a certain degree retailers, where it definitely is much more contingent on that rate trajectory continuing to come down, right? So we'll allow that short term, we're going to have some issues in terms of consumer sentiment, consumer spending patterns, but we think that the upper half of the income distribution is still in very good shape. Will end up driving the retail bus as we go into the end of the year and the holiday season.
Correct me if I'm wrong, but I think going into late 26, your forecast for Bitcoin and Ether are pretty good, yes?
Not mine, but our team's. So we're looking for continued follow through there. It kind of comes back to your discussion earlier on how to think about your alts in terms of gold and crypto. And I think your commentary is spot on there. I mean, I think we just have to allow that. You have a very aggressive momentum-driven equity market, and so I think people don't want to miss that. So you're looking for your hedging opportunity, and the way we see it, in addition to central bank buying, as you mentioned, I think that those two asset classes become hedges of choice as you're trying to navigate this ongoing strength, highly valued but momentum-driven equity market.
Do you think that investors are right to sort of brush past the government shutdown the longer that it goes on?
I've been brushing past it. I've been brushing past it because I view it as temporary, and I think as we get into the Q3 reporting period, we'll hear more about traditional fundamentals, less about that influence. But Sarah, to your point, the longer this goes on, the more it's going to have a tag-on influence. And so, but I'm not in a position to say how quickly we're going to get to a solution. No. But yeah, to your point, the longer it goes, the bigger of an issue it's going to be.
Well, and I do wonder about damage.